Slowdown in the housing market gets worse. Mortgage rates now topping 6%. That's a double from just a few months ago. We're looking ahead to the National Association of Home Builders sentiment out at 10 a.m. Eastern this morning. But the Journal is out with a good piece this morning talking about falling home sales rippling through the economy, providing a window into the rate impact and how it's cooling spending in the housing-related area. Your thoughts?
Oh, there's no escaping that reality. There's no escaping that reality.
Yes, exactly. Michael Lee?
Yes, so there's only two ways the Fed can really slow down or tame inflation, and that's either by that's supply and demand. And so what they are going for right now is to crush demand, and you've seen this in the housing market. And so in the housing market, I would say, and I think most people would agree, that the housing market was way too hot, and we're since down about 5% in all-time, from the median home sale price from all-time highs, 430,000 down to about 407,000, according to Redfin. You have home sales year over year down 20%, and inventories 3% higher. And with a 30-year mortgage getting up above 6%, you have to imagine this trend will continue. What's really significant for broader market implications on this housing data is the multiplier effect of the new home starts. You're down roughly 30% in terms of new home starts from just a few months ago, where we peaked out in post-crisis in the post-crisis era. So what is that? What kind of implications is that going to have for the broader economy? As you mentioned, the Home Goods and the Home Depots and these other sorts of places that sell into that. This kind of knock-on effect, I think, is unavoidable. I think this, while it's unfortunate for people involved in these industries, it is a necessary thing that has to happen when this housing market was just way too hot for way too long.
So should we be avoiding anything housing related right now then, Mike? I mean, look, the 30-year fixed rate hit 6.02% last week. It was at 2.86% a year ago. So that's serious impact there. And one area that the Journal points to is the furniture producers, the furniture companies, the home furnishing store stocks have all come down and business is down. Do you want to avoid anything housing related right now?
Yeah, absolutely for the time being. And isn't it ironic that as supply chains are starting to come back online, the demand is vanishing? So it's kind of damned if you do, damned if you don't in this sort of situation. If you can recall, just not that long ago, it was taking years to be able to get a new couch. Now you're going to kind of see this whiplash effect across all of retail where many of these retailers were buying massive amounts of inventory ahead because of the supply chain backlogs. Now that demand is drying up, a lot of these orders are coming in. You've seen that with Walmart and Target. It'll be interesting to see if any of these other smaller retailers are able to manage their supply chains better. So it's I think we needed this to help curb inflation, to slow down the economy, but it's also insane that the Fed was still buying $40 billion a month of mortgage bonds just a few months ago.
That's right. We said that earlier. They were buying $120 billion throughout 2021 and continued the buying spree up until when they raised rates in March of this year. So, John, you said you are expecting a recession, and it depends on how severe it is in 23. Mike, do you see the same thing? Are you expecting that too?
Yeah, well, look, we're already in a recession right now, and I don't see how a recession going forward is unavoidable. Okay. If you look at the long-term charts of housing starts, new home sales, and you see them cratering, typically the economy follows shortly thereafter. So I don't know how protracted or how deep this recession will be, but we're definitely having one.
Gentlemen, thanks very much. We want to take a look at what's happening in New York City.